Hello, here we are again. We're in the fifth lecture, I think, if you count the intro one. Moving right along. I want you to notice that we're really kind of just building, we just continue to build our foundation, right? One of the first things we learn is the accounting equation and what makes equity go up, what makes equity go down, right? And then we started learning transaction analysis, right? Now, last lecture we started talking about creating the financial statements, mainly the income statement, statement of equity, balance sheet, correct? So we're just building on each other, right? The next lecture, this is a good one too, but the next one is a very important lecture, so make sure you are here for my face-to-facers, and for you at home, make sure you watch that whole thing. You might even want to watch it more than once, because we're going to do some major stuff in lecture number 6. But let's take care of lecture number 5 first, all right? So let's go through the homework real quick. Now, one homework that I don't believe I had got to last time was exercise 1.8. Is that correct? Exercise 1.8 I had not got to. Get a piece of paper out here. So let's go through exercise 1.8 real quick. All right. This kind of tests our knowledge of the accounting equation. Okay, OfficeMart has assets equal to $123,000 and liabilities equal to $53,000 at year end. What is the total equity for OfficeMart at year end? What do you think? $70,000. Now that one wasn't too tough, was it? Okay. Okay. Now the next two, and I think I kind of alluded to this last lecture. Switch over here. We want to focus on the accounting equation. Assets equals liabilities plus owner's equity, correct? And we know that that needs to be true at the beginning of the year. It needs to be true at the end of the year. And even the changes that occur, it has to be equal. Okay? So let's read exercise 1.8b, and let's just kind of put in the information as we read it. At the beginning of the year, Logan Company's assets are $200,000. So let's put $200,000 in there. And its equity is $150, correct? Well, we know liabilities, don't we? What are liabilities? 50. Okay? During the year, assets increase 70,000. So they must be 270 at the end. And liabilities increase 30,000. So liabilities go up by 30,000, is that correct? 50 plus 30 is 80. So we now know owner's equity, because that has to equal that plus that, correct? So what is owner's equity? 190? Okay. So does that equal that plus that? Yep. Does that equal that plus that? Yep. Does that plus that equal that? Does that plus that equal that? And how much did owner's equity increase by then? Plus 40,000. Does that equal that plus that? It's like a puzzle, isn't it? Okay. Has to work like this. Has to work like this. It's like a Sudoku puzzle, right? Jake, you could do these on a date. With your date, you could do this on a Friday night. This would be fun, wouldn't it? Do puzzles together? Counting puzzles? Oh, that'd be great. Okay. So, questions on that one? Okay, let's do another one then. Let's do another one. Let me see if I got another piece of paper here. Let's see if I can just lay that over. Okay. At the beginning of the year, we're on C on exercise 1.8. C, at the beginning of the year, Keller Company's liabilities equal 60,000. During the year, assets increased by $80,000. And at year end, the assets equal $180,000, right? Okay, well, let's start filling in what we know. What plus 80 equals 180? This is 100, right? Well, that equals that plus what? 40? Okay. Let's see what else they tell us. Liabilities decrease $10,000 during the year, correct? So liabilities go down by 10,000. So 60 minus 10 equals what? 50? So what does owner's equity have to equal? 130? 40 plus what equals 130? 90? Okay, well, does 80 equal negative 10 and 90? Yeah, it does, doesn't it? Okay. See how those work? Okay. I usually like to have one of the two of those on a test. See if you really understand. Kara?
So instead of putting an actual minus sign, you'll just put brackets?
Yeah. I will do both.
Okay.
So a lot of times I'll just use the brackets to indicate minus or deducted from. Cool? All right, that is exercise 1-8. Okay? Okay, let's take a look then at Quick Study 1:12. All right? Quick Study 1:12. Okie doke. Now, I will have a test question like this. I guarantee. Okay? I think another skill we want to make sure we have is to be able to look at an account and know what financial statement it goes on. Okay? To look at an account and know what financial statement it goes on. Matter of fact, when students come into my office, regardless of their accounting class that they're taking, I always like to do things to kind of assess to see how strong their foundation is in accounting. And one of the first things I'll ask them is I said, let me give you some accounts, tell me what financial statement they're on. And if they don't know how to do this, then I know we got work to do, okay? This is one of those fundamental things that you want to make sure that you have, okay? All right. Quick Study 1:12. Indicate which financial statement each would most likely appear. The income statement, the balance sheet, the statement of owner's equity, or the statement of cash flows. Not real concerned about the statement of cash flows because you're not going to prepare it in this class. So I want you to know it exists, but that's about it. But okay, assets goes on what? Assets is on the balance sheet on Quick Study 1:12. Revenues goes on what? Income statement. What does the liabilities go on? Balance sheet. Equipment goes on the balance sheet. Withdrawals? Statement of owner's equity. Statement of owner's equity for withdrawals. Expenses goes on the income statement. Total liabilities and equity? Balance sheet. Cash from operating activities actually goes on the cash flow statement. I don't expect you to know that. The net increase or decrease in cash also goes on the cash flow statement. I'm not so concerned that you know about that. Okay? What if they would have said, what if one of the choices would have been ending balance of owner's capital? What would the answer be? Ending balance of owner's capital.
Owner's equity?
Actually, there's two of them, right? It's the last line of your statement of equity, correct?
Yeah.
And then it also flows over to your balance sheet. So the ending balance of owner's capital actually shows up on two financial statements. Statement of equity and the balance sheet. Cool? Remember how these things flow. Income statement, statement of equity, balance sheet. Got to prepare them in that order. And that's what we're going to do now, right? How'd you guys do on exercise 114, 115, and 116? Cool? Okay, here's what I want to do is This is kind of a simplified, or this is probably the most simple example that you'll do. And I'll tell you why here in a second. But here is why, here's kind of the process I encourage students to utilize when they have a problem like this. Is to go through each of these items or accounts before you start doing the financial statements and decide what financial statement they go on. Okay? So let's take a look here. Cash is on the balance sheet. Is that correct? As is accounts receivable, supplies, land, office equipment, accounts payable. All of those are on the balance sheet, correct? Now, see, they made it easy for you because they kind of grouped everything together. We're going to start working on one today that's not as easy, okay? But they grouped everything together as far as what financial statement it goes on. Now, owner's investments, and I said let's assume that those were made like either the 2nd or the 3rd of October. That would go on what? The statement of owner's equity. Okay? What about the cash withdrawals by owner? Statement of owner's equity, correct? Consulting fees earned, that's another sort of term for revenues. That goes on the income statement, as does rent expense, salaries expense, telephone expense, miscellaneous expense. Okay? Those all go on the income statement. Okay? Now, as we prepare those financial statements, which one are we going to start with? The income statement. And as you utilize these or put these on one of the financial statements, put a little check number or circle the account so that you know it ended up somewhere. Okay? So let's take a look at exercise 114, the answer. All right? Okay, so we're going to use which ones on the income statement? That one, that one, that one, that one, and that one, correct? And the income statement looks like this. Okay? That's what the income statement looks like. I'm going to make some comments about it, but first why don't you just take a look at it, see if your numbers are right. Okay, let me make some comments about it. First of all, it's prepared in proper form or in good form, isn't it? You have the name of the company, the name of the statement, and it's dated properly. Don't just put October 31. Put for the month ended October 31. Okay? Now, they didn't give us a year, or you would have put that as well. Okay? Now, they have their revenues, and then they have their expenses. Common question is, well, what if my expenses are in a different order? That's completely fine. You know, they obviously did this from largest expense down to the smallest expense, which is a common way you'll see an income statement. But you can do it. You can list those however you want. Okay. Now I want to make sure that you listed those expenses. I don't want to just see that for your income statement. Those numbers right there. Okay? No, I want the details as far as what those expenses are. That gives the reader a lot more information so they can make their decisions. Correct? All right. Any questions on that? Yours might look a little different, like I said. That's okay. Any questions on that? Kind of a rule of thumb, too, is often you'll put a dollar sign at the very top and a dollar sign at the very bottom, okay? But you don't have to put dollar signs everywhere. Here they did it because it was the top of this column. All right? Okay, any questions on the income statement? Okay, now let's take a look at the statement of equity. See if we can get it both on here. Okay, and where do we get that net income? It flows down, doesn't it? flows down from the statement of equity, which is why we have to prepare them in this order. Okay? All right. The beginning balance of capital was 0. We added investments by owner of $74,000, which was made on either October 2nd or October 3rd. I can't remember which I told you. We add the net income. You know, this subtotal right here, I think is kind of not a real worthwhile subtotal. So if you didn't have that, that's fine. Then you deduct your withdrawals by the owner, and you get in-king capital at October 31st. Is this prepared in proper form or in good form? Yes. Name of the statement, name of the company, and it's dated properly. It'll always be dated the same way between the statement of equity and the income statement. Okay. So is there any questions on that? Any questions on those? Like I said, I promise you'll be doing this on test. Okay, on the first test, which is over chapters 1 and 2. Cool? All right. Okay, then what's the next one we prepare? The balance sheet. And what's the ending balance of capital? It's $75,750. If you look over here, right? The ending balance is $75,750 right here at the bottom, and that's going to flow over to your balance sheet. There it is right there. Whoops, let me get it straight first. There it is right there. Okay, take a look at that. I'll let you check your numbers there real quick, then I'll have some comments about it. Okay. First thing you look at with the balance sheet is you want to make sure it balances. Do the total assets equal the total liabilities plus the equity? Yes. Now make sure you total those and make sure you label them. I don't like numbers that don't have a label next to them, especially if it's the one at the very bottom. So make sure you say total assets, $83,250. Total liabilities and equity, $83,250. Okay? Is it prepared in proper form or good form? Yes. The name of the company, the name of the statement, and it's dated properly. Now this one is dated, you could either say as of October 31st or just October 31st. But do not say for the month ending October 31st. A balance sheet is a snapshot in time, correct? So we want to make sure that it's dated correctly to reflect that. What happens if your balance sheet doesn't balance? You did a boo-boo, made a mistake, right? Now, when you guys take the test, and when I ask you to prepare these 3 financial statements, I've had students go absolutely bananas because their balance sheet did not balance. I'm a pretty nice guy. I mean, if you prepared it, you know, if you did a pretty good job, but you maybe just made a little math error along the way, but it's prepared neatly and you did most things correct, you're going to get partial credit. But please don't be like some students have done in the past. I've had students spend 30 minutes on their financial statements on the test because they were getting a little obsessive. It doesn't balance, and so they were neglecting the rest of their test because they spent 30 minutes. I've got to find why this doesn't balance, right? Relax, breathe deep, okay? Do the best job you can, do the rest of your test. If you've got time, you can come look for it again. But there is partial credit here, okay? Because a lot of times my students will, on the test, they'll thumb back and do the problems first, the financial statements. They'll do that first before they do any of the multiple choice or anything else. Okay? Any questions on that? Great. Okay. I believe that was all the homework I assigned. Is that correct? Okay, so we're going to talk about a few other things today, and then we're going to do a little bit of work here in class on some things, okay? But one thing I want to go back to today is remember when we talked about the revenue recognition principle, okay? Let's go take a look at the screen real quick. Okay? We talked about that there's principles and assumptions of accounting for which all the rules are built upon, correct? And we talked about the revenue recognition principle, which is very important. Just to reiterate, we recognize revenue when it is earned. When is it earned? When the product or service has been delivered to the customer. Not necessarily when the cash changes hands, correct? So let's just do a quick example, and I want to introduce you to a new account. Let's say our buddy Jake here. Let's go back to the example where, let's say he's the guy who mows my lawn, okay? And so let's say that actually, let's look at this from the perspective of Jake, not from me, but the perspective of Jake and his accounting books, okay? So let's say I say, hey, can you mow my lawn next week? And he says, yeah, and I said, it's $50, right, to mow my lawn? He goes, yeah, that's right. I said, let me give you the $50 now, but you don't need to mow it until like next Thursday. Okay? He says, that's fine. I said, I don't know if I'm going to see you next week, so let me just give you the $50 now. So I give him a $50 bill. Okay? Well, on Jake's accounting records, and if we were doing the transaction analysis, how would we record that? Well, I'll show you. We would say cash for Jake went up by 50, correct? And then we would have an account called unearned revenue that would also go up by 50. Now, unearned revenue is a liability. Sometimes people think that unearned revenue is a revenue because it has the word revenue in it. It's not. Unearned revenue is a liability account, and thus it goes with the other liabilities on which financial statement? Where do liabilities go? Balance sheet. Unearned revenue is a liability, and it goes on the balance sheet. So, taking a look back at this. Jake, when I give you $50 and you're keeping track of this in your records, your cash goes up by 50, your unearned revenue, your liability goes up by 50, right? Okay. Thursday comes and you mow my lawn. Well, a transaction that you will make at that point is your revenue will go up by $50 as soon as you're done mowing my lawn, and unearned revenue, that liability, now goes down because you've satisfied that. Does that make sense? And of course, me as the customer, I don't know you're making this entry. I really don't care, right? But for your books, taking one more look at this, when you got the cash went up by 50, unearned revenue, liability went up by 50. When you provided the service, unearned revenue, liability was decreased, and your revenue, you could book it as revenue at that point. Cool? Okay, let's talk about these other principles. What about the cost principle? Well, the cost principle is this. That means that you base your accounting information on actual cost because that is objective. Let me give you an example. Okay? Marlon, let's say that you had a business and you bought a used truck for it, okay, off of Craigslist, okay? And I said, how much did you buy the truck for? And you say, I bought it for $8,000 cash. And I say, that $8,000 cash is what you paid for. That's good. Good deal. And you say, here's the beautiful part, Dave. I took it to my brother who works at a used car lot. He knows cars. He knows what they're worth. He knows trucks. He knows what they're worth. He said this thing's worth at least $13,000. I got a deal. He goes, and you know what? I looked it up on the Blue Book value. It said it's worth $12,900. And I got it for $8,000. I got a deal on this thing. This thing's worth $5,000 more than what I paid for it. Okay, well, that's all good and fine, but when you record that asset on your books, Marlon, it goes on your books at $8,000 because that's what you paid for it. And if I look at your canceled check, that's what it's going to say, $8,000, right? We can't just put assets on our book what we feel like they're worth because that would be pretty easy to distort, wouldn't it? Right? Okay? So, we put what we paid for it. That's the cost principle. The matching principle. I don't want to focus too much on this one. This is more of a Chapter 3 concept. But this talks about how we're going to match the expenses to the revenues that they help to generate. Let's just wait till Chapter 3 to talk about matching principle. I won't be asking you that on the first test. What about the full disclosure principle? A company is required to report the details behind the financial statements that would impact the decisions of the user. Okay? I want to show you something here. Okay? I want to show you something here. If you turn in the very, very back of your book, you're going to see a real-life financial report. Okay? You're not going to be able to see the details, but if you look in the very back of your book, it's pages like A2, A3, A4. Okay? This is a exact photocopy of an annual report for this company. This is a real-life company, Research in Motion. I think they do like cell phones and stuff. Okay? Well, as you thumb through it, you're going to see on page A5 the balance sheet. You're going to see the statement of operations, which is a nice way of saying this is the income statement. Okay? There's a shareholder statement of equity on page A7. Okay? Here's the statement of cash flows. I talked about that one. Okay? Now, you can kind of thumb through that at home. I know you can't see the details either on the screen here in class or on your monitor. But the next thing that they have is they have notes and notes and notes. Okay? They talk about their inventories. They talk about their fixed assets. They talk about their investments. Okay? They have some other little reports and schedules here to kind of support things. Okay? They have a lot of different notes and stuff, don't they? Well, those are called the notes to the financial statements. All right? Now, matter of fact, let's say you're considering investing in a company and you get an annual report. And if you're in a business class, you might have to analyze a real-life company someday, and you might have to go obtain the annual report. Okay? I actually say, before you look at the financial statements, look through those notes. Look through the notes that I showed you. It'll talk about things like, here's what our company does. This is what we sell. This is where our markets are located geographically. Okay? These are some major changes that happened this year. And then they'll talk about some of their different accounts. Then go look at those financial statements, and it makes a lot more sense, right? Because you've got some context to put it in. Does that make sense? But going to this financial statement, going to this principle, the full disclosure principle, that just states that a company is required to report those details. Okay? They're not the financial statements themselves, but they're the notes to the financial statements. Does that make sense? Okay. Let's go to the next page of principles. There's also something called a going concern assumption. Now, this is the assumption that the business is going to continue operating. Okay? As opposed to being liquidated or closed or sold in the near term. Now, if you did think it was going to be closed or liquidated in the short term, it would have to say so prominently in those notes that I just showed you. Okay? Because that's pretty important, isn't it? Okay? But if you don't see that, then you can assume that it's going to continue going on. Cool? Marlon.
Are those notes prepared like, some company, like in the examples that we have in our books, like monthly or yearly?
Good question. Great question. The ones that you saw are annual. Okay? But most companies also prepare monthlies for their own use. But the annual report is obviously just 12 months. Okay, good question. Any other questions?
Is this mostly for large corporations, or do small businesses have to do all the notes and everything too?
Great question. Great question. That was obviously a large company, wasn't it? And large, you asked if all companies have to do this or just large ones. All companies do. Now, you could even have, here's the deal. If you are a publicly traded company like Research in Motion, that's their annual report. They send that to the shareholders, okay? Or if you're thinking about investing it, they send it to you. But you can be a small company. Like, let's go back to Jake. Let's say he has a landscaping business, okay? Well, you're not publicly traded. You're not buying stock. They're not following you on CNN Financial, right? But let's say that you have a loan with the bank. A bank helped you start your business by giving you a loan. A lot of times one of the requirements of that loan is that you have to provide periodic financial statements, either every quarter or every year. And when you give those, yes, you have to have the notes behind them as well. It may not look as colorful, it may not look as slick, it may not have as pretty pictures, but you have to prepare the same thing. Now, if you're just a business on your own, let's say Jessica owns a business, no bank has given her money, it's just her. She'll probably still want to prepare those financial statements, and she'll probably have to have stuff like that for tax purposes, but then the requirements are a little bit less, okay? So, but yeah, when I was an external auditor, I would help do those financial statements and help write those notes and a lot of those things. Okay, so good question. Any other questions? Okay, let's hit on these last ones real quick. The monetary unit assumption. Okay, this is the assumption that says transactions and stuff will be reflected in monetary units. So if it's the United States, it'll be the U.S. dollar. Okay. If it's in Europe, it'll be the euro. If it's in Japan, it'll be the yen, right? Your financial statements will be in some sort of monetary unit. That kind of goes without saying. What about the business entity assumption? That states a business is accounted for separately from other business entities, including its owner. Okay? So Jake, your landscaping business that you have, you want to keep track of it separately from your personal life. And I think we talked about that in a previous lecture. Don't commingle. Don't commingle your records. Don't commingle your checkbooks. You want to keep track of those separately. And if you have more than one business, you want to keep track of those separately from each other. It's its own business entity. Make sense? It's a big mess if you get it all mixed up. Okay? And then the last thing is the time period assumption. That states that the life of a company can be divided into time periods, such as months or years or quarters and all those sort of things. We can kind of divide things up properly. And we'll talk more about that in Chapter 3. But that's the time period assumption. Okay? All right. Any questions on that? Any questions? Yes, Kara.
On the business entity part of it, if you, let's say your business checking account's low and you transfer money from like your personal, what would that be considered, and how would you would you have to pay yourself back? Or
okay, that's a good question. What you're saying is if your business is low on cash, but you've got some personal money, you want to put it into it, that would just be another investment by the owner into the business. Okay. That investment by the owner is one of those things that increases capital or equity. That can happen not just at the very beginning of a business, but at any time. And you could treat that as one of two ways, but probably going to treat that as an investment by the owner into the business. And then, of course, you can withdraw. If you start getting a lot of cash in there, you can withdraw cash from the business. It'll decrease your capital and equity. So, okay. Good. All right. Let me look over my notes real quick, see if we've gone over what I want to get through. All right. What I am going to do now is I am going to Jake, will you do me a favor and hand one of these out to each person here? We are going to work on something. This is a financial statement preparation. I'm going to put it up on the screen for you. Okay. This is for Valentine tree trimming. Valentine tree trimming. Okay? And what I want you to do is I want you to prepare the 3 financial statements for Valentine tree trimming. Okay? Now let me give you a few check figures on this. We're going to start on it during class, but I don't think we'll have time to do the whole thing. Okay? Let me give you some check figures. The net income is going to be $7,040. Okay? The ending capital on the statement of equity is going to be $31,540. And on the balance sheet, the total assets will be $34,020. Those are all dollar figures. Okay? Now, you're going to notice something different on this Valentine tree trimming. Take a look at the list of accounts. What is different? What's different about my list of accounts? Look at it real quick.
They're all mixed up.
Yeah, it's alphabetical. I didn't group them all together by what statement they go on, okay, like the book did. I just gave them to you in, not random, but alphabetical order. So you really need to go through, first and decide what financial statement it goes on, okay? And then look, now don't get started yet, guys. And then as you use these accounts, put a check mark by it, or I guarantee you're going to miss one. Okay? So circle it or put a check mark as you do it. Okay? Now you folks at home watching this, you have this worksheet. Okay? This is in the Lessons tab underneath the chapter. Okay? Under Chapter 1, you'll see Valentine tree trimming, or it's called something like that. So you need to print these things out and have them ready for class, because we're going to work on this in class a little bit while that snazzy, jazzy JCCC music plays. And you folks at home, work on it as well. Let's at least try to get through the income statement. Okay? Any questions before we turn the music on and turn the audio off? Any questions? Okay, first thing you want to do is go through that list of accounts, decide what statement it goes on, and then start preparing your income statement, then your statement of equity, then your balance sheet. This is a past test question. This exact question was on a test, okay? So this is going to be a good indicator of what you need to do on the exam. So let's play that snazzy, jazzy music, and let's go ahead and work on this for a while, okay? Wait, question before we go. That's right.
Is unearned revenue on the income statement, or is that a liability?
I'm glad you asked
that's a
that.
liability.
Unearned revenue is that account that we just talked about. And what type of account is unearned revenue? Liability. It's a liability. It goes on the balance sheet. But where do people always make the mistake on the test and put it on? Revenue. They put it as a revenue in the income statement. Unearned revenue is a liability. Okay? Okay. Any other questions? Now let's go. All right. Start to work on that. Okay, a couple people asked some good questions about this as they were working on it, and I'll answer those. But first, let's just look at the income statement, okay? Let's just look at the income statement. And you can do the rest for homework, okay? Here's the income statement. Can you guys see that all right? Okay, you've got your revenues minus your expenses equals a net income of $7,040, right? Okay, did I prepare this in good form or proper form? Yes. Now, did you guys circle these or check them off as you're using them? Do that. I promise you, if you don't do that, you're going to forget to put an account on a financial statement. So the first thing that you should do is go through and decide what statement these things go on, and then circle them or check them off as you use them. Okay? Now, somebody asked on this one, they didn't see an investment by owner. There's not always going to be investments by owners every month. But the top line of your statement of equity will be that balance of capital. Okay? Will be that balance of capital at 731.13 of 28,000. Okay? So what I want you to do, or is there any other questions about this? About the income statement? Kara?
On the directions, it just says August 2013. Should we put just that, or should we put the 31st?
That's a good question. A lot of times things will be stated like that. It's understood it's at August 31,
okay,
2013.
so you want us to put...
Yeah.
Okay.
So, I mean, if you didn't, that's fine, but I said for the month ended August 31. Good
Okay.
point. Okay? All right, any other questions? Okay, let me give you your homework. Here is the homework I want you to do. I want you to finish the Valentine handout, okay? I want you to do Quick Study 1.6. And then I want you to read about return on assets, ROA. It's on pages 22 and 23 in your book, and do exercise 118, okay? Each chapter has a ratio at the end of it, and we'll talk about those. Make sure for next lecture, which is a very important lecture, you have your PowerPoints for Chapter 2. Okay? That you have your PowerPoints for Chapter 2. Is everybody here signed up for Connect? Okay, good. Are you folks at home signed up for Connect yet? Because next class period, we're going to talk a little bit more about the Connect assignments. Okay? All right, any questions? Got your homework? Good class period. Next class period's a really important one. We shall see you, okay? Bye-bye.